Greetings to you all candidates. Today I'm going to answer question number 3, Advanced Financial Management. The sitting is November 2020. Question 3A, I read, explain the differences between the following terms as applied in mortgage and financial markets. Roman 1, primary mortgage market and secondary mortgage market, 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage, 2 marks. Roman 3, lien and recourse, 2 marks. We'll first give the difference between primary mortgage market and secondary mortgage market. Candidates, the primary mortgage market is where prospective homeowners connect with primary lenders to secure mortgages for both owner-occupant and investment properties. Whereas secondary mortgage market is an expansive arena in which financial institutions and investors buy and sell mortgages. And the goal is to provide a reliable source of money that alleviates some of the risks associated with owning mortgages. That's the difference between primary mortgage market and secondary mortgage market. Roman 2, fixed rate mortgage and adjustable rate mortgage. A fixed rate mortgage is a mortgage loan for which the interest rate remains constant throughout the term of the loan or the term of the mortgage. Whereas the adjustable rate mortgage is a loan with an interest that changes. Lenders normally charge lower initial interest for the adjustable rate mortgage than the fixed rate mortgages. So candidates with the adjustable rate mortgages, the interest rate and the monthly payments change monthly. They may also change quarterly. They may change yearly and so on. So that's the difference between fixed rate mortgage and adjustable rate mortgage. Roman 3, lien and recourse. Now, a lien, candidates, gives an individual or an entity a claim to a property until a debt is paid off. And if the debt goes unpaid, they have the right to take it back. Recourse, on the other hand, in a recourse, candidates, the lender can foreclose the secured asset and also has recourse to the borrower himself, which means that the lender can collect the debt from the borrower's unsecured personal assets and from his future income. That's the difference between lien and recourse. 2 marks. I'll now move to answer part B, which I read. The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million shillings available for investment. A financial analyst they hired to appraise some possible projects they can invest in has availed the following information. There's a column for project, then another column for initial outlay, there is a column for expected return, then a column for standard deviation. The projects are PQRS. PQRS are the projects, and the initial cash outlay 9 million, 7 million, 6 million, 8 million respectively. Expected return is 12%, 21%, 16%, and 14% respectively. Standard deviation 2.5%, 1.8%, 2.3%, 1.6% respectively. The covariances between various projects' contribution are as follows. Project pairing PQ The covariance negative 3.1, PR 1.3, PS negative 4.1, QR 1.5, QS 1.7, RS 2.7. Additional information. Number 1. The management is planning to invest by pairing the projects. Number 2. The maximum capital that can be invested is the accumulated fund as shown above. Number 3. Any paired project is mutually exclusive and none of the projects is divisible. Required. For each possible project, required, I repeat, required, Roman 1, for each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation. How many marks? 12 marks. Roman 2, advise the shareholders of Mali invested holdings on the optimal project pair based on the mean variance criterion. How many marks? 2 marks. That's question 3B, November 2020, Advanced Financial Management. We are going. Greetings to you all candidates. Today I'm going to answer question number 3, Advanced Financial Management. The sitting is November 2020. Question 3A, I read. Explain the differences between the following terms as applied in mortgage and financial markets. Roman 1, primary mortgage market and secondary mortgage market. 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage. 2 marks. Roman 3, lien and recourse. 2 marks. We'll first give the difference between primary mortgage market and secondary mortgage market. Candidates, the primary mortgage market is where prospective homeowners connect with primary lenders to secure mortgages for both owner-occupant and investment properties. Whereas secondary mortgage market is an expansive arena in which financial institutions and investors buy and sell mortgages. And the goal is to provide a reliable source of money that alleviates some of the risks associated with owning mortgages. That's the difference between primary mortgage market and secondary mortgage market. Roman 2, fixed rate mortgage and adjustable rate mortgage. A fixed rate mortgage is a mortgage loan for which the interest rate remains constant throughout the term of the loan or the term of the mortgage. Whereas the adjustable rate mortgage is a loan with an interest that changes. Lenders normally charge lower initial interest for the adjustable rate mortgage than the fixed rate mortgages. So candidates with the adjustable rate mortgages, the interest rate and the monthly payments change monthly. They may also change quarterly. They may change yearly and so on. So that's the difference between fixed rate mortgage and adjustable rate mortgage. Roman 3, lien and recourse. Now, a lien, candidates, gives an individual or an entity a claim to a property until a debt is paid off. And if the debt goes unpaid, they have the right to take it back. Recourse, on the other hand, in a recourse, candidates, the lender can foreclose the secured asset and also has recourse to the borrower himself, which means that the lender can collect the debt from the borrower's unsecured personal assets and from his future income. That's the difference between lien, and recourse. 2 marks. I'll now move to answer part B, which I read. The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million shillings available for investment. A financial analyst they hired to appraise some possible projects they can invest in has availed the following information. There's a column for project, then another column for initial outlay, there is a column for expected return, then a column for standard deviation. The projects are PQRS. PQRS are the projects, and the initial cash outlay 9 million, 7 million, 6 million, 8 million respectively. Expected return is 12%, 21%, 16%, and 14% respectively. Standard deviation 2.5%, 1.8%, 2.3%, 1.6% respectively. The covariances between various projects' contribution are as follows. Project pairing PQ, the covariance negative 3.1, PR 1.3, PS negative 4.1, QR 1.5, QS 1.7, RS 2.7. Additional information number 1. The management is planning to invest by pairing the projects. Number 2, the maximum capital that can be invested is the accumulated fund as shown above. Number 3, any paired project is mutually exclusive and none of the projects is divisible. Required for each possible project. Required, I repeat, required, Roman 1, for each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation. How many marks? 12 marks. Roman 2, advise the shareholders of Mali Invested Holdings on the optimal project pair based on the mean variance criterion. How many marks? 2 marks. That's question 3B, November 2020, Advanced Financial Management. We are going to take, first of all, question B, Roman 1. For each possible project pair combination, for each possible project pair combination, calculate expected return, calculate correlation coefficient, calculate standard deviation. First of all, candidates, we are going to we need to first of all get the possible project combination. Possible project combinations. Okay? The question does not give this project combination. We are told that the management is planning to invest by pairing. And this company has a limit on capital as indicated in additional information number 2, that the maximum capital that can be invested is the accumulated fund. And the accumulated fund, we read in the first sentence that the accumulated fund of 15 million shillings is available for investment. So the company has 15 million shillings and the company can invest this money by pairing the projects. Like you can see project 1, which is project P, the initial cash outlay is 9 million. Project Q requires initial cash outlay of 7 million. That means project P and Q, combination of project P and Q is not possible because the total amount required to invest in project P and Q is 16 million, yet the maximum, the limit that the company has is 15 million. So project P and Q, combination project P and Q is not possible. But if you check project P and R, project P and R candidates, you can see project P requires 9 million, project R requires 6 million, which is equal to 16. 15 is equal to 15 million. Another combination is project P. There's no another combination with project P other than this R. The next one will be project Q and project R. Project Q and project R. The total initial cash outlay will be 7 million plus 6 million, which is equal to 13 million. Another combination is project Q and project S. The total initial cash outlay will be equal to 7 million, 8 million, 15 million. Then lastly, candidates, we can combine project R and project A. 6 million plus 8 million is equal to 14 million. That's the possible projects pair combination. Possible project pair combination. We have it right there. Now that's the starting point. It's on the basis of this possible project combination that we can now go ahead and calculate the expected return. The expected return. We'll first start with the expected return for the first possible project combination, PR. And to make our work easier, we will also calculate the correlation coefficient for project combination PR. We also calculate the standard deviation for project combination PR, and so on. So, what is the expected return for project combination PR? We'll have a small table here. First column is project. This project is PR, P and R. Then another column is the initial capital. Initial capital, project P, 9 million. Project R, 6 million. Then you'll have the weight. The weight is going to be 9 million plus 6 million, 15 million. The weight for project P will take 9 million divide 16 million. That will be the weight. 9 million divide 15 million. 0.6, that's the weight. Then 0.4, that's the weight for the second project. Then the other column is the expected return. We have expected return. Yes, in the question, expected return project P is 12%. Project R expected return 16%. Therefore, candidates, another column is now the we are going to calculate. We are going to multiply the weight, this weight, by the expected return to get the expected return for project PR. Expected return for project PR. We multiply and then add. We multiply this weight, 0.6 times 12% plus 0.4 times 16%. We get the total there. That will be the answer for expected return for project P combination PR. So candidates, we have 0.6 times 12, 7.2%, then 0.4 times 0.16, 0.064. We'll add the 2 plus 7.2. This is equal to 7 point, let me take it again, 0.4 times 16. This 6.4 plus 7.2, 13.6% is the expected return. This is the expected return for project PR, combination project PR. Then the question required candidates to compute the correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Now the correlation coefficient, candidates, will be equal to the covariance of project PR divide the standard deviation of P times standard deviation of R. Covariance of PR, covariance of PR, which we have in that question, candidates. We have the covariance of PR. PR is 1.3. It's 1.3. The standard deviations are also given in the question. For project P, standard deviation project P is 2.5 times standard deviation for project R. R is 2.3. 2.3. That will be equal to 1.3 divided by 2.5 times 2.3. This is equal to 0.23. 0.23 is the coefficient, correlation coefficient. Then we are required to compute the standard deviation. This is the standard deviation for the portfolio. We have the standard deviation for the individual projects. Here we'll compute the standard deviation for the portfolio. These are two projects. Standard deviation will be equal to, this is standard deviation for project PR, candidates. The formula is that this is equal to this square root. We're going to get the square root of weight of this, we're going to square the weight. We're going to square the weight of P, okay, weight of P, then we square the standard deviation of P, okay, square the weight of project P times the standard deviation of project P, then we add the square of the standard, the square of project, we square the weight of project R, project R, then we square we multiply. We are going to multiply the standard deviation, the square, this is just the variance, the variance of project R, all right, R, all right. Then candidates, we add 2 times weight of project P times weight of project R, then we multiply by the covariance. This is the covariance of PR, covariance of PR. So candidates, square the weight of P, square the weight of P, 0.6 squared times the square of the standard deviation of P, standard deviation P from the question, standard deviation 2.5 square plus 0.4 square times standard deviation R 2.3 square plus 2 times 0.4 times covariance of PR, covariance PR from the question, covariance PR 1.3. The rest is the work of the machine. We multiply 0.6 square times 2.5 square plus 0.4 square times 2.3 square plus 2 times 0.6 times 0.4 times 1.3. This is equal to, then I need to, before I need to get the square root 1.93. 1.93 is the standard deviation of the portfolio PR. We will do the same for combination QR. We will first calculate expected return, the expected return for combination QR. We'll have QR, this is the projects. Let me have columns, projects, then we have initial investment, then we have the weights, then we have the expected return, then we multiply the weight expected return. So project Q required initial investment of 7 million. Project R require initial investment of 6 million, total 13 million. So the weight will be, is going to be 7 divided by 13, 7 divide 13, 0.5, then 6 divide 13, 0.464. Expected return, the expected return from the question, we have project Q 21%, project R 16%. Therefore, the expected return for this portfolio is going to be 0.54 times 21 plus 0.46 times 16%. 0.54 times 21, 11.34, 0.46 times 16, 7.36. We add 11.34 goes to 18.7%. This is the expected return of the portfolio QR. Then the next requirement is the correlation coefficient. Correlation coefficient QR. Correlation coefficient QR is equal to the covariance of QR over the standard deviation of Q times standard deviation of R. Okay? Covariance of QR provided in the question is 1.5. Standard deviation of Q 1.8 times standard deviation R 2.3. It's that simple. 1.5 divide 1.8 times 2.3 is equal to 0.36. Then lastly, we are going to compute the standard deviation of the portfolio QR. Standard deviation of the portfolio QR, which will be determined by getting the square root of the weight, square the weight of Q times standard deviation of Q plus weight of R times standard deviation square of R. Then we are going to add 2 times the weight of Q times the weight of R. This is times the covariance QR. Covariance QR. This will be equal to the square root of 0.54 squared. Square the standard deviation 1.8 square plus 0.46 square times standard deviation of 2.3 squared plus 2 times 0.54 times 0.46 times the covariance of QR. The covariance of QR 1.5. That will be this is 0.54 times 0.54 squared, 4 squared times 1.8 square plus 0.46 square times 2.3 square plus 2 times 0.54 times 0.46 times 1.5. Then we get a square root this is equal to 1.68. 1.68 is the standard deviation. We do the same for portfolio QS candidates. We'll begin with the expected return for portfolio QS. I need space. Let me use this space. Expected return portfolio QS. For portfolio QS, we begin with the project Q, project S. Project Q requires initial investment of 7 million. S required initial outlay of 8 million. 8 million. Total 15 million. The weights will be 7 divided by 15. 7 divide 15, 0.4. 8 divide 15, 0. This is 5.3. This is 0.47. Those are the weights. Then we'll calculate we have the expected return given in the question for project Q. Expected return, project Q, 21%. Project S, expected return, 14%. So the expected return for the portfolio, QS will be 0.47 times 21 plus 0.53 times 14%. Okay, the expected return for the portfolio QS will be 0.47 times 21% plus 0.53 times 14%. 14%. Therefore, 0.47 times 21% is 9.87%. 0.53 times 14 is equal to 7.42% plus 9.87%, 17.29% is the expected return for the portfolio QS. Then we compute correlation coefficient for the same correlation coefficient for the portfolio QS. We know this is equal to the covariance of QS divided by the standard deviation of Q times standard deviation of S. Covariance of QS is provided, candidates, where it is written that the covariances between the various project combinations are as shown. Covariance for project QS, the second last, 1.7 divide standard deviation also given in the question for Q, 1.8 times the standard deviation is 1.6. Therefore, the correlation coefficient portfolio QS will be 1.7 divide 1.8 times 1.6. This is equal to 0.5. 0.59 is the correlation coefficient for the portfolio QS. The next requirement is the standard deviation of this combination or portfolio. The standard deviation of portfolio QS will be equal to the square root of the square of weight of Q times the square or the variance of Q variance of Q plus the weight of the square of the weight of S times the standard deviation squared of this is S. Then we are going to add 2 times weight of Q times weight of S times the covariance of QS. Covariance of QS. So this is equal to, this will be equal to the weight, we have it 0.47 squared. Standard deviation, we have it 1.8 squared plus weight 0.53 squared times standard deviation 1.6 squared plus 2 times 0.47 times 0.53 times covariance of QS, the covariance of QS 1.7. This will be 0.47 square times 1.8 square plus 0.53 square times 1.6 square plus 2 this is times, okay, 2 times 0.53 times 0.47 times 1.7. Then we get a square root. The answer here is 1.51. 1.51 is the standard deviation of portfolio QS. A portfolio is an investment or is a combination of investments, a set of investment, a group of investment. This company had an option of investing in project Q and S combination. This is combination QS. So the standard deviation of this portfolio is 1.51. Then we will again compute the expected return for combination RS, project RS, combination RS. Okay, so I'm going to have here the expected return for RS. So we'll begin with the project R and project S. Project R required the initial outlay of 6 million. Project S required initial outlay of 8 million. So we do the weights. This is 14 million. Therefore, the weight will be 6 divide 14 to get 0.42. Then we have 8 divide 14 to get 0.57. When we round off here, we have 3. Then there is the expected return for individual projects given in the question. For project R is 16%, project S 14%. Therefore, candidates, the expected return for the portfolio RS will be equal to 0.43 times 16% plus 0.57 times 14%. So 0.43 times 16%, 0.43 times 16% is equal to 6.88%. Then 0.57%, 5.7 weight times 14% is 7.98%. The total is 6.88 plus 7.98, total 14.866%. That is the expected return for the portfolio RS. Portfolio RS. Now, candidates, I'm going to rub here so that I can compute the correlation coefficient for the portfolio RS. Then I also compute the standard deviation for RS. But before I rub, candidates, I will need to have this somewhere. This is the expected return of the first combination. This one here, 13.6. 13.6. I'll need this 13.6% in the second requirement, Roman 2, where we are told to advise the shareholders of Mali investment on the optimal project paired on the mean variance. To calculate the mean variance, candidates, we divide standard deviation by the mean. In this case, the mean is the expected return of the portfolio. So I will rub here. Rub that. So currently 13.6% is the, this 13.6% is the expected 13.6%. This is the expected return of portfolio, the first combination PR. First combination was PR expected return, first combination PR. This is equal to 13.6%. I'll need that when computing the coefficient of variation, or the mean variance, Let's continue. We've done the expected return for portfolio RS. We are now going to compute the correlation coefficient RS, project RS. That will be equal to the covariance of RS divide the standard deviation of R times standard deviation of S. Covariance of project RS, portfolio RS, covariance RS 2.7 divide the standard deviation of R 2.3 times 1.6 times 1.6. So candidates, that will be the correlation coefficient, which is equal to 2.7 divide 2.3 times 1.6. This is equal to 0.73. Then lastly, standard deviation of the portfolio RS is equal to the square root of W squared R, standard deviation squared R, plus W squared S times standard deviation squared S, plus 2 into WR times WS, okay, times covariance RS. Covariance RS, this is equal to the weight, we have it 0.43 squared. The standard deviation, we have it 2.3 squared plus weight 0.57 squared. Standard deviation 1.6 squared plus 2 weight 0.43 times weight 0.57 times covariance, we have it 2.7. The rest is the work of the machine, the calculator. 0.43 square times 2.3 square plus 0.57 square times 1.6 square plus 2 times 0.43 times 0.57 times 2.7. Then we get the square root. The answer is 1.77. That's the standard deviation. Candidates, we've answered Roman 1, which read, for each possible project pair combination, calculate the expected return, number 1. Number 2, correlation coefficient. Number 3, standard deviation. That's what we've been doing for each project combination. For example, the project combination for QS, we've done the correlation coefficient. We've done the expected, firstly the expected return. We did the expected return, then we've done the correlation coefficient, we've calculated the standard deviation for the portfolio, we've QS, that is QS, candidates, that is QS. For each project we have done the expected return, correlation coefficient, and standard deviation. For project RS, we've calculated the expected return, we've calculated the correlation coefficient, we've calculated the standard deviation. We did the same for project PR, we did the same for project QR. So we are going to move to answer the second part of this question. Advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance. Based on the mean variance. The mean variance is also known as the coefficient of variation. So I'm going to rub this bit, but maintain. I'm going to maintain. This is QR. This one here is the expected return QR. We want to calculate the coefficient of variation or the mean variance. How to calculate the mean variance? Mean variance, candidates, mean variance is equal to the standard deviation over mean. So mean variance is equal to standard deviation divided by the mean. In our case, the mean is the expected return. The expected return is the mean. We have done the standard deviation for each portfolio, all right? For each combination of projects, we've calculated the expected return for each portfolio. So we want to determine the mean variance for each portfolio. And this one here, candidates, 18.7%, 18.7% is the expected return for QR. QR 18.7%. I'm writing it down there because I want to use this space. I want to use this space. So I have combinations. Then I'll have the first combination is PR. PR. We are going to calculate the mean variance for PR, and I've said is equal to mean divided by, the standard deviation divided by the mean. The standard deviation for PR, we calculated it 1.93. We divide the expected return for combination PR. Expected return here is 13.6. The next combination is combination QR. Combination QR. The standard deviation QR is 1. We calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS. Combination QS. The standard deviation combination QS is 1.51. QS 1.51 divided by the expected return QS. QS is QS, we calculated it. QS expected return QS here is 17.29. Then lastly, combination RS. The standard deviation combination RS, we have it here, 1.77 divide the expected return RS, expected return RS 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 8 point. This is 0.089. Next, 1.51 divided by 17.29. 1.51 divide 17.29. 0.087. Then lastly, RS 1.77 divide 14.86, 0.119. Now when converted into percentages, this is 8.9%. This is equal to 8.7%. Is equal to 11.9%. So those are the mean variances. These are the mean variances Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair, advise the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the project is, the risk is lower risk. It has a lower risk. Okay, 8.7. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficients, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P. Project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we are going to answer question number 4 that was tested in November 2020. Then we will again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
So let us look at allowable legal costs. Allowable legal cost number 1 is the legal cost for a lease, not more than 99 years. 99 years. So when you're doing your business and you decide you want to occupy a property, let's say a building, and that building you are going to occupy for 99 years, 80 years, 70, 10, 5 years, 1 year, and you decide to make it legal, you require a lawyer to help you in preparing that lease. And that lawyer even sign that document of the lease. And you pay for that service. That is what you call legal cost for a lease. As long as it's 99 coming down, that is a allowable expense. And that means if the lease is for more than 99 years, it can be 99 and a half years, 100 years, 105, 120, 150 years. That legal cost is not allowable. You cannot deduct it against the taxable incomes of the business. Number 2, we have legal costs for preparing staff contracts. That's another one. That in your business, when you are hiring your staff, some of your staffs may tell you, I want you to make this agreement legal. And so you will have to hire a lawyer. In the process of hiring a lawyer, they charge you some fee and you pay. When it comes to the taxation of your business, that you are allowed to deduct that legal cost when you're determining the taxable incomes of the business. After that, we have the third one. We have legal costs relating to customers and debtors. Although debtors are your customers, but it's good to specify, because most of the time you find that those legal costs normally relate to the debtors. A good example, a debtor has refused to pay you what they owe you. So you decide to take the legal process. You go to a lawyer, ask that lawyer if he or she can prepare for you a demand letter. You take to that customer to notify them that you're going to take a legal process. And now that lawyer writes for you that demand letter, but charge you like 3,000, 10,000. When it comes to the determination of your taxable income, you'll be allowed to deduct that legal cost against your taxable incomes of your business. Number 4, we have legal costs to list a company at stock exchange. We normally have what we call listed companies or quoted companies. These are companies whose shares are traded at stock exchange market. In Kenya, we have Nairobi Stock Exchange Market. That means anybody who may want to become a shareholder of that company just need to go there and you buy shares of that company. It's open. When that company was getting there, it could have incurred several costs. One of them was to hire a lawyer to help them in preparing the document for presentation to, for example, Capital Market Authority, for them to be allowed to, for their shares to be traded there. That legal cost they paid when they were getting there, it's supposed to be an allowable expense. Number 5, legal costs to defend property rights. It means you have, for example, land somewhere. You own that land. Or you could be owning a motor vehicle. Somebody from outside just come and say, this land used to be mine. This motor vehicle used to be mine. It was stolen from me. This building used to be mine. You decide, no, I bought these items legally. So you decide, let us go to court so that the judge can decide who owns these items. And because you are not a lawyer, you hire one to go and represent you. In the process, he charges you some legal fee. That is the one we are saying legal cost to defend your property. And when you pay, that become an allowable expense. The last allowable legal cost, number 6, is the legal cost relating to tenders. Tenders relate to your business. For example, you want to supply something to your customer. They tell you you have to tender. But maybe because you don't know the process of doing that, you hire a lawyer. Come and help me prepare these tender documents. They charge you some legal fee. That legal fee is supposed to be allowable. So these are the allowable legal costs. While still under the legal costs, I want us to also look at non-allowable legal costs. Non-allowable legal costs. It is the opposite of the allowable legal costs. That these are the costs or expenses which cannot be deducted against the taxable incomes of the business when you incur them. They are which one? Number 1, we have legal costs. Legal costs to purchase or transfer a fixed asset. The other name we normally give that cost is the conveyance fee. Why don't we allow it? Because here we said the legal costs we allow are the ones that are revenue, that the benefit can be realized within a year. The one that benefit extend beyond 1 year, we don't allow. Fixed asset is one of the item where you enjoy benefit for a period that is more than a year. So when you are purchasing, selling, you incur some legal costs that you're not allowed to come and deduct it against the taxable income of your business. That cost is also called conveyance fee. This is very common. So it is usually not allowable expense. It is related to the fixed asset. It's not allowable. We have number 2, legal costs to defend. To defend a crime. So what we saw, legal costs to defend your property is allowable. But if you commit a criminal activity and you're taken to court, you hire a lawyer to defend you, that legal cost will not be allowed by the taxman to come and deduct it in the business. Why? Because it is not business related. You are not doing business. So that is usually not allowable. Number 3, legal costs relating to bank loans, bonds, and debentures. Now we are talking about legal costs relating to bank loans. Why don't we allow them? Because loans are long-term financing. That when you take a loan, the bank will tell you to pay after 8 years or within a period of 8 years, 10 years, or even some others go to 15 years. So it's a long-term item. So the legal cost you incur when you're taking that loan is usually not allowable. Same case relates to bonds and debentures. When you hear companies issuing bonds, issuing debentures, they are taking loans from the members of the public. And being loans, they are long-term. They will tell you that we will pay you after 10 years or within a period of 10 years, 15 years. So the legal costs in the process of issuing those debentures, bonds, are usually not allowable. After that, we have number 4. Legal costs relating to memorandum of association and partnership deeds. Partnership deeds are also called partnership agreements. What is the memorandum of association? In law, we normally consider that as a constitution of the company, that it is the document that guides the company in the long term. So being in the long term means if the company lasts for 25 years, that memorandum of association will be there for 25 years. So it's a long-term document, not revenue. We call that capital expenditure. Partnership deed or agreements, the same. These are agreements that are signed between partners. And this agreement will be there in the partnership as long as the partnership is there, guiding the partnership, how they are supposed to operate. So it's a long-term document. So we don't usually allow based on that. After that, we have number 5. Legal costs relating to patents, copyrights, and trademarks. Now, legal costs relating to patents, copyrights, and trademarks. Now, this in financial accounting, we used to consider them as intangible assets. Intangible assets used to be classified under fixed assets, long-term assets. So you can see the reason why we don't allow them, because they are long-term, capital and not revenue. So legal costs you incur relating to that, or those ones, are usually not supposed to be allowable. Another non-allowable expense, legal costs, number 6, is the legal costs relating to breach of contract. That or contract. That if your business break one of the contract you have with your trading partners, be it customers, suppliers, be it staff, and they take you to court, and the court determine that you actually broke that contract, and actually sometimes we are going to see they fine you, that is not supposed to be allowable because you're not supposed to be breaking contracts. Another one, number 7, legal costs relating to tax matters. Yep, we are going to learn. Another one is that sometimes the KRA, taxman, can, for example, assess you and tell you are supposed to pay a certain amount of tax, but you're not satisfied with that. You decide to appeal or even object, but you don't want to do it directly. You hire a lawyer to come and help you in your defense. That legal cost you pay there is not supposed to be allowable. And this we are going to learn. It does not just restrict itself to the tax matters or legal costs relating to tax matters. It also says that all other expenses, as long as they are connected to tax, they are usually not supposed to be allowable because it's assumed you are the one who is supposed to handle your own tax issues. The last one, number 8, court fines and penalties. Now, when you talk of court fines and penalties, when you are fined, it means that you are the one who was on the wrong side. So it means that is not supposed to be related to the business. You did something that was outside what you are supposed to do. So when you are fined, you pay that fine. It's connected to legal matters. That is usually not supposed to be allowable. So these are the allowable legal costs, the non-allowable legal costs. But don't forget, we are still under the allowable expenses. Only that the legal one normally have several allowable and also non-allowable, and we had to look at them. So we go back to the list of the allowable. After number 5, we have number 6, another allowable expense of the business. Number 6, payment to trade associations. Now, to differentiate this allowable expense numbering, as you can see, we have number 6 here. From this allowable legal cost and unallowable, let me rename this one as A, B, C, D, E, and F. Same case here. A, B, C, D, E, F, G, H. Yeah. So that is just the numbering so that you can differentiate this continuation here from the legal costs. Now, back to number 6, payment to trade association. As the word say, trade association is an association that is related to your trade. What do we mean? For example, if you are operating a bank, they normally have an association called Kenya Bankers Association. It is there to improve the banks, help to fight for the interest of the banks. If you are in manufacturing, there is an association called Kenya Association of Manufacturers. It is there to trade and protect the interest of the manufacturers. So when a business pays to this association, it is helping to strengthen them, to help them fight for their interests. So that amount is supposed to be an allowable expense. Number 7, another allowable expense is the employer contribution on behalf of employees to pension schemes and provident fund. Which are these schemes? Pension scheme or provident fund is where employee and sometimes the employer make a saving for the retirement of an employee. A good example, in Kenya we have NSSF. When you contribute to NSSF, according to the law, the employer is also supposed to contribute similar amount for you. But when they do that, the time of their taxation, they will be allowed to come and deduct that amount against the taxable income. So that is an allowable expense. Number 8, research costs. Research costs and payment to research organizations. Research costs. If you are in the business, for example, you want to introduce a new product. Before you do that, to increase the chances of it succeeding, you need to do some research. What do the customer want? Are they okay with what you are giving them? In the process, those research costs you incur, at the time of taxation, you'll be allowed to come and deduct them against your taxable income. Same case, research payment to the research organization. A good example, if for example a farmer make a contribution or donation or payment to KEFRI, Kenya Kenya Forest Research Institute. So what do? They carry out research on the best, for example, trees that farmers can be able to grow and get maximum benefit. So when a farmer contributes to them, that is supposed to be an allowable expense when it comes to the year taxation. So research costs and payment to research organization. Number 9, we have advertisement expenses of revenue in nature. So the key thing there being advertisement expense of revenue in nature. Revenue, we said these are expenses you incur and the benefit is realized within a short period of time, usually within a year. So when it comes to the advertisement, you may find advertisement on radios, TVs, newspapers, preparing brochures. When you advertise in them, it is usually assumed, for example, when you advertise on radio, the customer can already remember what you have advertised within probably 2 weeks, 1 month. After that, they might forget what you advertised unless you continue advertising. So it's revenue within a short period of time. Those are allowable expenses. But it is important to note that capital advertisement expenditure are not allowable. You can put that. You note that capital advertisement expenditure are not allowable. Capital expenditure, we said, these are expense where you incur an expense, but the benefit you derive over a long period of time. It is the opposite of revenue. A good example is construction of a billboard, construction of a signpost, construction of neon signs. These are long-term advertisement items. When you put a billboard somewhere or a signpost, it advertises you for 10 years or even 5 or even 50. Some are there forever unless you do rebranding. So the cost of putting them up there is not allowable. What we do for them, we claim the capital allowance we talked about here. And we are going to learn, we claim the capital allowance we call wear and tear allowance, whose rate at the moment is 10%. So you take 10%. So if you construct a billboard for 100,000, first year you take 10% of it, 10,000. Then when you get to the second year, another 10%, but we're going to learn it's usually on a reducing balance. The third year, 10% that way, but on a reducing balance. So capital advertisement expenditure is usually not allowable. Then we go to number 10. Number 10. Number 10 of another allowable expense is the employer contribution on behalf of employees to members club. But that members club must be related to employees' work. Employer contribution on behalf of employee to members club. A good example of this is accountants. For you to be a fully recognized certified public accountant of Kenya, you must be a member of ISPAC, even when you are done with your CPA. When you become a member, you will note every year you have to contribute something we call subscription fee. Now, when you get employed, the employer may tell you, I'll be contributing that for you. Every year, I'll be contributing that for you. Because it is related to your work, that will be allowable when it's determining the taxable income. Number 11, we have realized foreign exchange loss. So, when you are looking at the incomes, we had specified that realized foreign exchange gain is a taxable income. Unrealized foreign exchange gain, an untaxable income. How about in case a loss is generated? If it is realized, it is an allowable expense. If not realized, it's usually an unallowable expense. Number 12, another allowable expense, donation to charitable organizations that is supposed to be another allowable expense. Question is, which are these charitable organizations? According to the Income Tax Act, it specifies that they include any organization that advances religion, education, or to alleviate the poverty in the society or suffering in the society. If you look at that definition, religion, we are talking about churches, mosques. When you talk of education, we are talking about schools. When you talk of alleviation of poverty or suffering, we are talking about like Red Cross. We are talking about NGOs. So when you make or your business make a donation to them, that is supposed to be an allowable expense. And this we are going to learn. Any other donation is not supposed to be an allowable. Any other. So if you find donation to a political party, that is not supposed to be an allowable expense. A general donation, that is not allowable expense unless it is specific, it's to a charitable organization. Number 13, we have interests on money borrowed and invested in business. That if a business take a loan from a bank and that money is invested in your business, the interest you pay every year, every period, that's supposed to be an allowable expense in that particular year. And we saw that there's another form of loan, usually taken by the limited companies, debentures. When a company issue debenture, or bonds, when a company issue bonds, these are forms of loans. So when they pay interest, those interests are supposed to be allowable expenses. After that, we have number 14. Payment to directors of a company for service rendered. That's supposed to be a allowable expense. Directors are considered to be employees of the company. So when you pay them director salary, director's fee, director commission, allowances, all these are supposed to be allowable expense because they have rendered the services to your business. So these are the allowable expenses of the business, and this is according to the Income Tax Act. You get them there. After looking at the allowable expenses, we need to look at non-allowable expenses. These are expenses which cannot be deducted against the taxable incomes of the business. Which are these non-allowable expenses? We have number 1, non-revenue stroke capital and non-commercial expenses of the business. That is number 1. This is actually the opposite of what we saw in the allowable number 1, where we said all revenue and commercial expenses of the business are allowable. And we explained. And we said these are 2 broad terms. Same case here. These are 2 broad terms. And when we talk of non-revenue or capital, these are expenses of the business where the benefit is realized over a long period of time. A good example is the costs of a motor vehicle, a fixed asset. You purchase a fixed asset, you don't use it with 1 year and that is over. You use it 1 year, 2nd year, 3rd, 5th, that way. So its cost is not allowable. What we do with it, we said, is to claim a capital allowance which we said is supposed to be allowable expense. The other one is non-commercial. Non-commercial, we said these are expenses which are not related to the business activities. A good example, we said private expenses of the owner, like rent expenses of the owner at home, electricity expenses of the owner at home, salaries and wages to the house help, gardeners at home. These are usually not allowable because they are not commercial, they are not business related. So any expense that you come across that is non-revenue or capital, that is non-commercial, know that that is not supposed to be an allowable expense. Number 2, we have non-trade, bad debts written off. We said trade bad debts written off is allowable because you are writing off a debt relating to the business trade. Like when you sell goods on credit, they refuse to pay. That's allowable. But those that are not related to the business, for example, you had sold a fixed asset, you had lent money to your customer, your staffs, your relative, they refuse to pay, and after 4 years you decide to write them off, those you cannot be allowed to deduct them against your taxable income of the business because they are not related to what you do on a daily basis. Number 3, general provision for bad debts. The other way to put it is increase in general provision for bad debt. We had said if it is specific provision for bad debt or increase in specific provision for bad debt, that is allowable. General provision, we said, normally arise as a result of estimation. So when you compare general provision at the start and at the end, and you find that they have increased, for example, at the start 20, at the end 25, that year it means that you created 5 million more. That is not supposed to be allowable against the taxable incomes of the business. Number 4, we have depreciation. Depreciations are usually not allowable. And we said depreciation is an expense related to the accountants. In taxation, we don't recognize that. Instead of depreciation, we recognize the capital allowances. So depreciation is not allowable. Number 5, we have the costs of fixed assets. Although we had said or mentioned that under the cost of fixed assets, so this is an unallowable expense, and we said we had mentioned this one here, that capital expenditure or non-revenue expenditure are usually not allowable. Reason, they are long-term costs. So you benefit out of them in the long term. So we don't usually allow them. Number 6, we have loss on disposal of fixed assets. Fixed assets. That when you dispose your fixed asset, like if you have motor vehicle as a fixed asset, furniture as your fixed assets, and you dispose them in the course of your business, if you generate a loss, it's usually non-allowable. And actually, if you remember, we said when you are looking at the incomes of the business under non-taxable, we said income or profit from the selling of fixed assets, we don't tax because these are not the items that you deal with in the business. So you make a profit, don't tax. You make a loss, don't allow it. Don't deduct it against the taxable incomes of the business because these are not the items you deal with in the business. They are not stock. They are not goods. Number 7, we have loss on disposal of investments. Now, why don't we allow the loss on disposal of investments? It's because of this. Investments are different activities from what you do on a daily basis. So when you dispose your investments like shares, rent of property, you make a loss, let it be remain in those investments. If it is rental and you have rental income, deduct it against now rental income. If it is shares, you dispose, you make a loss, it's supposed to remain there. If you're supposed to tax that income from shares, it remains there. Deduct against that income of that share. So, but don't bring it in the business. It's usually a non-allowable expense. Number 8, we have impairment. Impairments of intangible assets. We said depreciation is usually for tangible assets. For intangible assets, we don't usually depreciate them, we impair them. So impairment is the same as depreciation, only it relates to intangible assets. So same way, we don't usually allow them. Number 9, we have private expenses of the owner. Private expenses of the owner. So, we had also mentioned here that it is a non-commercial expense. It is not related to the generation of income. It's also important to note specifically expenses relating to the owner, electricity expense relating to the owner, salaries, rent, name them, water at home, don't bring them into the business. They are not usually allowable because they are not commercial. Number 10, we have all forms of taxes. All forms of taxes. Taxes like which one? Income tax, corporation tax, value added tax, stamp duty, excess duty, import tax, or what we call custom duty. All these are usually not allowable. If you say any form of tax, don't allow, don't deduct, it's not allowed. Not only that, we have number 11, all expenses relating to tax. This I had mentioned when we were looking at the allowable expense and the legal costs, where we had said that legal costs relating to tax we don't allow. Now I also expound that not only the one relating to legal, but any expense relating to tax, like tax consultancy fee, legal fee to hire a lawyer, any other. Sometimes you may not have paid your taxes, and the taxman charge you the penalties, charge you the interest on the tax overdue. All these are not supposed to be allowed. Any expense related to tax, we don't usually allow. Number 12, operating loss. Operating loss exceeding 10 years. Those are usually not allowable. What do we mean? That if you generate a loss in the business in 1 year, let's say in the first year, you can carry it forward to the next year, year 2. If in the first year you made a loss of 10 million, year 2 you make a profit of 30 million. Before you are taxed on 30 million, the taxman allows you to deduct the 10 million, the loss you made in the first year. So in the second year, instead of being taxed on 30, you'll be taxed on 20. So it is now favorable to you. How about in case second year you don't make a profit? You can carry the loss of the first year and now the second year to the third year. Deduct them against the taxable profit of that year. If that year you don't make a profit, carry it to the fourth year. You can do that up to a maximum of 10 years. But after it exceeds 10 years, for example, the one you generated in the first year, now you are in the 10th year, you are moving to the 11th year. In the 11th year, if you make a profit, don't deduct against the loss you generated in the first year. It is not allowed. You can now only deduct it against the loss you generated in the second year. Maximum period we are saying there, you can carry forward an operating loss is usually 10 years. That is number 12. Number 13, we have all donations except to charitable organization. That we had said under the allowable expense, donation to charitable organization, and we gave example, churches, schools, Red Cross, children's home, these are charitable organizations. Those are allowable. When you have any other form of donation, don't allow. To a political party, a general donation, don't allow, unless it is specific is to those charitable organizations. Number 14. Number 14, all provisions and reserves except specific provision for bad debts. That when we are looking at allowable expense, we said specific provision for bad debt is usually allowable. General provision is not allowable. Not only that, and actually under the non-allowable expense, we had mentioned that general provision for bad debt is not allowable. But it can even go beyond that. That you may have provision for salary. Like if you know next year you have salaries to pay. Next year you have rent to pay. You may provide it in this year. That this is the provision for salary for next year. That is not allowable. Something equivalent to that is reserve. That if you realize that next year you need to pay rent, electricity, you may put some money in the reserve somewhere to be used when that time comes. That is not allowable. If you decide to deduct it in the incomes of the business of that year, it is not allowable. It can only be allowed when you incur that expense now. When that time comes and now you need to pay electricity and you pay next year, that will be allowable against the incomes of next year. But any other is usually not allowed. After that, we have number 15. Unrealized foreign exchange loss. We said what we allow is the realized foreign exchange loss because it's already generated, it's already incurred. But unrealized, where you say if you exchange foreign currency, you think that you're going to make a loss because of the current exchange rate, but you have not changed that currency. That loss cannot be deducted against the incomes of the business. You are not allowed to do that. Number 16, we have expenses relating to the owner of the business. Expenses relating to the owner of the business. What does that mean? You normally find, like in partnership, the partners may be working in their business. So they decide to pay themselves salaries, commission. Sometimes they charge interest on capital they have invested in the business. Because they are paying themselves, that is usually not allowable. Anything paid to the owners of the business. Same case when it comes to the company. The company is owned by shareholders. So at the end of the year, the shareholders may decide to pay themselves dividends. And we have several forms of dividends. You can have interim dividend, final dividends, proposed dividends, any kind of dividend. It is relating to the owner. That is usually a non-allowable expense. So this one here are the ones that we call non-allowable, and they cannot be deducted against the taxable incomes of the business. So that one mark the end of this topic of looking at the incomes of the business, the classification, where we have the taxable, the non-taxable incomes, where we have the expenses, allowable and non-allowable. And this one generally carry all the weight as long as you are taxing the business. It's the core area. Actually, I call it the constitution relating to the taxation of the business. So you have to really understand these expenses and the incomes. The one we call taxable, the non-taxable. the expenses are allowable and allowable. So it's my prayer that you go through them all alone, look at them one by one, try to understand what we have explained. So for now, I think for this topic is over. Then it's my hope that I'm going to see you in our next topic. The next topic would be about one of the allowable expense that we had here, the allowable expense number 4, where we talked about capital allowance. In the capital allowance, we said it is usually granted in place of depreciation, where we say depreciation is for accountant. In taxation, we call that capital allowance. And we said it is used in relation to the cost of fixed asset. So how do we grant capital allowance? And if I remember, we also said there are several. There is an investment deduction, industrial building deduction, the wear and tear allowance, the farm work allowance, the mining allowance, and diminution in value of roost tools. So I hope to see you in our next lesson. Thank you.
Welcome, learner, to our human resource management subject. In our lesson today, we are continuing with the foundational theories of human resource management. And today we are looking at another interesting theory, that is the resource-based theory. The resource-based theory suggests that resources that are valuable, rare, difficult to imitate, and non-substitutable best position a firm or an organization for long-term success. These strategic resources can provide the foundation to develop firm capabilities that can lead to superior performance over time. J. Barney is considered by many scholars as the father of modern resource-based view. So this theory, learner, is very instrumental to underpin the thinking of human resource management practitioners and scholars, in the sense that it provided and suggested an avenue and put in place a thinking that human resource management has used over time to be able to look at the kind of resources the organization can develop in comparison with its competitors. And according to this theory, if a firm is to develop those 4 aspects, there is the element of valuable, rare, difficult to imitate, and non-substitutable, then the firm can position itself over time to be able to achieve superior performance through capabilities that it has built. What is critical for us to note here is that this theory supports the inward-looking approach, where an organization should look for competitiveness from inside, not from outside. Look at the resources you have as an organization. Try to look at how you can refocus the capabilities that organization has. You can develop that and be able to compete effectively, but using internal resources. So what are some of the characteristics of strategic resources? We have talked about long-term success, strategic resources. So you have what you call characteristics of strategic resources. What are some of the characteristics of strategic resources? And these are the characteristics that an organization has to focus on to ensure that these particular resources are clearly articulated, clearly developed. So one, we have indicated that one of the characteristics of strategic resources is that these resources are expected to be valuable. These resources are expected to be valuable resources inside the organization. Number 2, these resources are expected to be rare. if resources are readily available, then those ones are not categorized as strategic resources according to this particular theory. And then number 3, strategic resources are expected to be difficult to imitate. And finally, number 4, those particular strategic resources that an organization is supposed to build should be non-substitutable. Non-substitutable. So this is what those who support this theory of the resource-based theory argue, that if an organization can look inward, okay, so an organization can look at the inward resources. So these resources are supposed to be valuable, these resources are supposed to be rare, these resources are supposed to be difficult to imitate, these resources are non-substitutable. So once an organization identifies and builds the capabilities from internal sources, then that organization can be said to be able to at least achieve long-term success over its competitors in the markets in which it operates and so on. So what are some of the uses of resource-based theory? Uses of the resource-based theory. What are some of the areas in which the resource-based theory can be used? So the way we have seen that the resource-based theory looks at the internal competencies, internal resources that an organization has, then can focus, the resource-based theory can help an organization to focus on organizational internal resources. Number 1, can help an organization to focus on internal organizational resources. Now, looking at this from the human resource point of view, now the people, okay, for example, people or human resources, people or human resources. An organization can develop its people or its staff in such a way that those staff can, for example, be rare, they can be valuable, and they could be difficult to imitate in terms of the kind of training that organization subjects these workers to. So that is one way of helping an organization develop. Then the other one is assist an organization to develop unique resources. Assist an organization to develop unique resources. So the underpinnings of this human resource-based theory, resource-based theory, can help an organization to be able to look at how it can develop unique internal resources to be able to compete and be capable of doing things that its competitors cannot do. Then this can also help in identification of needed competencies. An organization can now be able to look inward and be able to identify identification of needed competencies, so that the organization now knows we need technicians, we need laboratory staff, we need radiology staff, for example. So this theory can be able to assist an organization identify the competencies that that particular organization requires to be able to at least build its strategic resources as we have indicated there. Then this can also help an organization in strategy formulation, can assist, helps in strategy formulation, because remember, these strategic resources are supposed to help an organization in the long term, okay? In the long term. So if an organization now develops a strategy, that organization can be able to develop a strategy and focus 15 years, 20 years from now and so on. Then an organization can also be able to maybe focus on attaining a competitive advantage. Is it? Number 6, improving on quality standards, improving on quality standards. And then if you have an organization that is focusing on the resource-based theory, that organization can be able to improve on quality standards, because the quality standards that that organization adopts may help that particular organization to compete effectively in the market. And then number 7, distinguish an organization from its competitors. So that again is one of the areas where the resource-based theory can be able to assist an organization. Then there is also the aspect of choice of human resource management practices to be adopted in an organization. Also, number 9, to guide research in management and related areas. So that one can also be one of the areas where the resource-based theory can be able to be used in relation to carrying out research to find what underpins performance in relation to different arrangements and so on, and also determination of success factors in an organization. So, dear learner, these ones are just some of the areas in which the resource-based theory can be used, and we can be able to summarize them very quickly. Today we have looked at the resource-based theory, and we have indicated that the resource-based theory postulates or suggests that resources that are valuable, rare, difficult to imitate, and non-substitutable best position a firm for long-term success. These strategic resources can provide the foundation to develop capabilities that can lead to superior performance over time. J. Barney as we have seen, is considered by many scholars to be the father of modern resource-based view. We have looked at the characteristics of strategic resources, and we have said there are 4 characteristics, and 1, they should be valuable, rare, difficult to imitate, and non-substitutable. So those ones are the 4 characteristics of strategic resources that an organization needs to identify and develop. And what you need to know, learner, these are focusing on internal resources. So this particular theory looks at the internal resources and how an organization can look inward to be able to compete. And what are some of the uses of the resource-based theory? We have indicated number 1, can help an organization to focus on internal organizational resources like people or human resources. Number 2, assist an organization to develop unique resources. Number 3, can help identification of needed competencies. Number 4, helps in strategy formulation, especially focusing on the long run or long term. Number 5, focus on attaining a competitive advantage. Number 6, improving quality standards. Number 7, distinguish an organization from its competitors. Number 8, choice of human resource management practices to be adopted in an organization. And number 9, to guide research in management and related areas. And then number 10, another use of the resource-based theory, it can be used in the determination of success factors in an organization. So learner, those are some of the areas where human resource based theory or the resource-based theory can be used in HR or human resource and other areas. So before we finish our lesson, you have an assignment that you need to work on. Assignment. And your assignment, learner, is analyze the application of the resource-based theory, Analyze the applications of the resource-based theory. So learner, we have come to the end of another interesting lesson where we were looking at the foundational theories of human resource management. And in our lesson today, we have concentrated on resource-based theory, where we have looked at what is meant by the resource-based theory, who was the founder or father of this theory, and we have said was J. Bunny. We have looked at the characteristics of strategic resources, and we have looked at the uses of resource-based theory, where we have looked at the first one, which is it can help an organization focus on the internal organizational resources like people or human resources, and the 10th one was determination of success factors in an organization. And we have finally wrapped up our lesson today by looking at an assignment that is analyze the applications of the resource-based theory. Thank you very much for being attentive.